If you've been watching silver over the last few days, you've probably noticed how aggressive the headlines have become. Some are warning that something big is about to happen. Others are promising that the next 2 weeks will change everything for silver holders. And if you own silver, that kind of messaging creates a familiar feeling. Urgency without clarity. You've seen the thumbnails. You've heard the phrases. Final setup. Last chance. Something massive is coming. But what rarely follows those claims is context, numbers, probabilities, or a framework for what to actually do if nothing dramatic happens at all. That's what we're going to focus on today. Yes, the next 14 days matter for silver, but not because of a secret event or a single explosive catalyst, or because silver is about to break the financial system. They matter because of how silver is positioned right now, technically, sentiment-wise, and across related markets, and how that positioning tends to resolve over short windows like this. This is Financial Briefing. The goal here is calm, data-driven analysis. No hype, no fear, no pretending we know the future with certainty. Just probabilities, context, and a clear way to think about risk. Before we talk about what could happen over the next 2 weeks, I want to anchor this discussion in accountability, because analysis only matters if it's tracked honestly. Earlier this year, in late February when silver was trading around $23, we said the odds favored a move toward the mid-20s before any sustained pullback. That move played out over the following month, with silver reaching roughly $25.50 before consolidating. In early April, when silver briefly dipped below 24 and sentiment turned negative, we said downside risk was likely limited unless gold also broke down. Gold held firm, silver stabilized, and prices recovered into the high 20s by May. More recently, when silver approached $30 and enthusiasm accelerated rapidly, we cautioned that the move was constructive but stretched in the short term and that volatility, not a straight line rally, was the more likely outcome. Since then, silver has traded in a wide range between roughly $30 and $33. None of those were perfect calls, but they followed the same process: probabilities over predictions and structure over emotion. That brings us to where silver is right now. As we head into this 2-week window, silver is trading roughly between $31 and $32 per ounce. That places it well above its long-term averages, but still within historical ranges seen during transition phases rather than final tops. The first data point that matters here is volatility. Over the last 30 trading sessions, silver's average daily range has expanded from about 50 cents to roughly 80 to 90 cents. That's a meaningful change. Historically, when silver's volatility expands this quickly, it usually signals a decision phase. What that means is the market is reassessing risk. Traders are adjusting positions. Stops are being tested. New participants are entering while others are questioning whether to stay. What it does not mean is that volatility guarantees a breakout higher. Expanded ranges occur before rallies and before pullbacks. Volatility is a condition, not a direction. The second data point is futures participation. COMEX silver open interest has risen to approximately 155,000 contracts, up from around 135,000 a month ago. Participation is increasing, liquidity is increasing, attention is increasing. Historically, rising open interest alongside rising prices suggests new money entering the market, which can support trends. But when open interest rises faster than price confirmation, it can also set the stage for shakeouts. What this means is the market is more crowded than it was a few weeks ago, but not crowded enough to assume a top. What it does not mean is that silver is on the verge of a forced event or structural failure. Those claims surface every cycle, and they almost always overstate short-term implications. The third data point is short-term momentum versus long-term structure. Silver's 50-day moving average currently sits near $29. The 200-day moving average is closer to 26. At current prices, silver is roughly 10% above the 50-day and more than 20% above the 200-day. Historically, silver spends most of its time within about 8% of its 50-day average. Being this far above it doesn't promise to mean silver must fall, but it does mean the market needs either time or price to rebalance. What this tells us is that upside from here is possible but not cheap. What it does not tell us is that silver is overbought in a way that forces an immediate reversal. Overbought conditions can persist for weeks during strong trends. Taken together, these 3 data points explain why the next 14 days matter. Not because something dramatic has to happen, but because this is the window where positioning, volatility, and expectations tend to resolve into either continuation or consolidation. From here, the question becomes which scenario is most likely, and what that means for anyone holding silver right now. To understand what the next 14 days could realistically bring, it helps to separate what's possible from what's probable. Silver is one of those markets where extreme outcomes get the most attention, but moderate outcomes happen far more often. So let's start by laying out the bullish case clearly, without exaggeration. The first bullish factor is structural price behavior. Silver is holding above $30, a level that capped it repeatedly over the last decade. Markets tend to remember these zones. When prices spend time above a long-term ceiling, it often changes how participants perceive value. Even if silver doesn't surge immediately, the willingness to transact above 30 matters. The second bullish factor is the real rate backdrop. While nominal yields remain elevated, inflation-adjusted yields are not aggressively positive. Historically, silver struggles when real yields are rising sharply and performs better when they're flat or drifting lower. Right now, we're closer to neutral than restrictive. The third bullish factor is industrial demand. Solar, electrification, and grid investment continue to absorb silver supply. These are not speculative trends, they're policy-driven and multi-year. That doesn't guarantee upside over a 2-week window, but it does reduce the probability of a sharp, sustained breakdown without a macro shock. The fourth bullish factor is ownership. Despite the noise online, silver remains underrepresented in institutional portfolios. Precious metals allocations, where they exist, still favor gold heavily. Silver is not a crowded trade in actual capital terms. If these factors dominate, the bullish scenario over the next 14 days is not a vertical move, but continuation. Silver holds above 30, absorbs volatility, and gradually works toward the upper end of its recent range. A test of $34 to $35 would be plausible under this scenario. I assign that outcome a probability of roughly 25%. Now let's talk about the bear case, because this is where many investors underestimate how unforgiving silver can be. The first bearish factor is extension. Silver is meaningfully stretched above its short and medium-term averages. That doesn't force a reversal, but it increases vulnerability. When expectations rise faster than confirmation, disappointment tends to express itself through price. The second bearish factor is speculative positioning. Managed money long exposure has increased more quickly than physical demand indicators. That creates asymmetry. If price stalls or drifts lower, those positions can unwind quickly, amplifying downside moves.